It's a new year, and 2026 brings some of the biggest tax changes UK taxpayers have seen in years. Whether you're self-employed, earning extra income on the side, renting out property, or simply unsure if you even need to file a return, this year is not business as usual. Tax thresholds are still frozen. Digital reporting is expanding. And HMRC is using more data than ever before to check who's paying the right amount of tax. That means more people could be pulled into filing and paying without realizing it until it's too late. In this video, we'll break down what's changed, who it affects, and what you should do now to stay compliant and avoid unnecessary penalties. No jargon. No guesswork. Just clear, practical guidance to help you stay in control of your tax position in 2026. Let's start with the basics. How much you can earn before paying tax. In 2026, the personal allowance is still frozen at £12,570. It hasn't increased, even though wages and living costs have. The same applies to the higher rate threshold, which remains fixed at £50,270. As incomes rise with inflation, more people are quietly being pulled into paying tax, or pushed into the 40% band, without getting a real pay rise. This effect is known as fiscal drag, and it means middle earners are often hit the hardest. If your income has gone up in recent years, it's worth checking where you now sit, because crossing these thresholds can happen faster than you think. From April 2026, making tax digital is no longer just for a small group. If you're self-employed or a landlord earning over £50,000, these rules will now apply to you. That means keeping digital records, using MTD-compliant software, and submitting quarterly updates to HMRC instead of one annual tax return. For many people, this is a major shift in how tax is managed. The risk is leaving it too late. Under the new system, missing updates or submitting incorrect information can quickly lead to penalties. The key point is this: April isn't when you start preparing. The time to get organized, choose the right software, and build good habits is now, before digital reporting becomes mandatory. If you earn income from dividends, 2026 could feel noticeably tighter. The dividend allowance has now dropped to just £500, down from £2,000 only a few years ago. That means a much larger share of dividend income is now taxable. Capital gains tax has also changed for small investors. The tax-free CGT allowance is now £3,000, making it easier to trigger a tax bill when selling shares, property, or other assets. For anyone investing outside an ISA or running a limited company, these reductions can add up quickly. If you haven't reviewed how your investments are structured, now is the time, because even modest gains can now create a reporting requirement. If you sold items online, took on freelance work, drove passengers, or rented out a spare room, this part matters. In 2026, HMRC has significantly expanded its data sharing powers with digital platforms like eBay, Airbnb, Uber, Etsy, and Fiverr. These platforms now report earnings directly to HMRC. That means HMRC can see what you've earned, even if you've never declared it yourself. Many people assume side income doesn't count if it's casual or irregular. But if your total income from side hustles goes over £1,000, you may need to register and file a tax return, even if you already have a full-time job. What's catching people out is visibility. Income that once flew under the radar is now flagged automatically, and HMRC can follow up with letters, assessments, and penalties. The message is clear. If you've earned extra income in the last year, don't ignore it. Check your totals, understand your obligations, and deal with it early. Because waiting for HMRC to contact you is usually the most expensive option. HMRC is tightening the rules in 2026, and penalties now arrive faster than many people expect. Miss a filing deadline, and you could face a £100 fine from day one, even if no tax is owed. Late payments also attract interest, which continues to build until the balance is cleared. And under digital reporting, missing quarterly updates can trigger penalties as well, not just the final return. The risk isn't just the cost, it's the speed. Small delays can now turn into multiple charges very quickly. If you're not staying organized and up to date, you're risking more than inconvenience. You're risking avoidable fines that add up fast. So what should you do to stay ahead of these changes? First, check whether you need to file a tax return this year, even if you didn't in the past. Next, get Making Tax Digital ready. Choose compliant software, keep clear digital records, and start tracking income as it's earned. Make sure you're recording all income, freelance work, side hustles, rental earnings, dividends, everything. And don't leave it until the deadline, especially with quarterly updates becoming the norm. Set aside time this week to get organized. These changes aren't on the horizon, they are already here, and acting early puts you back in control. 2026 is a major year for UK taxes. Stay informed, stay organized, and you'll avoid penalties before they start. Subscribe for clear, practical updates, and stay ahead of every UK tax change.